DSTs, an alternative replacement property for 1031 exchanges. This is our 5th week of hosting Thursday webinars, providing meaningful content, information, and the opportunity to connect for our members. Today's webinar, again, is jointly hosted by the Pennsylvania, New Jersey, Delaware chapter of CCIM, as well as the Mid-Atlantic chapter of CCIM. So we've reviewed this slide weekly, and as you can see, there's a lot of good benefits of being a CCIM. Love to have you join us for our educational events, and I'm certainly, you know, just becoming a member and getting involved with our group. So at this point, we'd like to again thank our sponsors. Without their help this year, we couldn't do it without them. So we have 1031 Corp, Barley Snyder, Brandywine Realty Trust, Capstan, Certified Abstract, Hinking Group, Paninian Bank, BL Companies, Penn Community Bank, Rittenhouse Capital Advisors, and Univest. Thank you again to our sponsors. So we're already in May, and so our upcoming courses, as you can see, we had a foundations course this past month. We have more coming up. So we have core courses, a CI 101 in August in Pittsburgh, another Foundations for Success in Commercial Real Estate in September in Pittsburgh, the CI 102 in October in Plymouth Meeting, and the CI 101 also in Plymouth Meeting and also later in October. So we also have upcoming webinars, so stay tuned and mark your calendars. So on May 14th, we have tax strategies to fund capital improvements. And on May 21st, data center transactions. And that should be interesting. Both should be interesting events, and you can register online at the website at the bottom of the slide there. Great, so welcome to Margo McDonnell and Craig Fernsler.
Thank you.
Thank you. I'm Margo McDonnell. I'm the president at 1031 Corp. I'm a certified exchange specialist and a member of the Counselors of Real Estate. And I have been in the 1031 industry now for over 26 years and involved in transactions of all size and complexity nationwide. And I am joined today by Craig Fernsler, who many of you know. And Craig bought his first investment property in 1989. He got his real estate license in 1990 and flipped his first property in the early 90s. He started buying and acquiring real estate and, started buying and acquiring apartments and mixed-use properties in the late 1990s and started acquiring and developing land in 2001. And as an agent, he's been helping commercial and residential real estate clients buy their real estate to maximize wealth and sell their properties to minimize their capital gains and recapture taxes for more than 30 years. Our objective this hour is to provide the basics of a 1031 exchange. We'll review the benefits of exchanging, and we'll give you an overview of Delaware Statutory Trust, or DSTs. We'll look at the benefits of DSTs and discuss opportunities to increase transactions and solve problems for your clients. And of course, we'll wrap it up with Q&A. And I just want to go back to providing a basics of 1031s. We're not going to go into great detail on 1031 exchanges, but if anybody wants more information on exchanges, please feel free to reach out to me after the presentation, and I could get you some information about upcoming webinars where I will cover more. So what exactly is a 1031 exchange? And I know many of you are working with them, so we're just going to do a quick refresher for those that aren't doing many of them or may forget the rules. But a 1031 gets its name from Section 1031 of the Internal Revenue Code, and it provides that no gain or loss will be recognized on the exchange of real property held for productive use in a trade or business or for investment. And I know that's a mouthful, but really a 1031 exchange is really the sale of a business use or investment property followed by the purchase of another one within 180 days and linked together by the necessary documentation. And we're going to review all the requirements in just a few moments. But 1031 exchanges are not new. They've been around since 1921. So for over 99 years, taxpayers have had the ability to defer the gain when selling investment property. And the whole principle behind 1031 exchanges is continuity of investment. It's really the continuation of that first investment. So the property where the money is housed may change, but the underlying investment, the equity investment, is still there. And the principle was, if you're not paying any, if you're not receiving any cash in your pocket, why should you have to pay the taxes now? And that's why a 1031 allows you to defer the gain so that you can keep that money reinvested. And it encourages reinvestment, which is not only good for the real estate market, as we all know, but also the economy. So I'd like to go through a really quick example just to highlight the power of a 1031 exchange. In my example, and it's not a huge transaction, but single family rental property held for many, many years. We had somebody actually that had that, and he wanted to get into the commercial real estate market. He had an annual salary of $125,000, and he had $50,000 of passive income through interest, dividends, and rental income. So we had a total of $175,000 of income. He originally paid $250,000 for his property. He made no capital improvements over the years and took $150,000 in depreciation. And now he's going to sell it for $500,000. So we could quickly look at that and know that he's going to pay tax on his profit or his gain. And that's the difference between what he paid for the property, plus any capital improvements if he had done any, and what he's selling it for today. So his gain is $250,000. If we add that $250,000 to his $175,000 of income, he's going to be in the highest income tax bracket. He's going to be in the highest capital gain tax bracket, and he would be subject to the 3.8% net investment income tax on all of his unearned income, which would be his $250,000 of gain, as well as his $50,000 of passive income. So if we just calculate the tax consequences on his sale, selling for $500,000, his capital gains at just 15%, even though we know some of it would be 20% based on his income, he would have $37,500. So note that would be a little bit more. The 3.8% net investment income tax surcharge would be $9,500. And then his depreciation recapture, the $150,000 of depreciation recaptured at 25%, is another $37,500. So his federal tax liability is $84,500, leaving him with just $415,500 to reinvest. If he was able to use that as a 30% down payment, he could buy something for, I think it's $1.3 million. And that would allow him to take that jump into commercial real estate. And I did see the question about the 3.8% net investment income tax. And yes, it is something referred to it as the Obama tax, but it is the Medicare tax that was part of the Affordable Care Act that was signed in 2010, and this provision kicked in 2013. Alrighty, so how does that work if we do our 1031 exchange? Well, we don't have that $84,500 to reinvest. So now we have $500,000 to go into the replacement property. And using that as a 30% down payment, we could leverage that into a property that is $1.66 million. So that higher price replacement property would allow you to collect higher rents from day one, have more depreciation available moving forward, and long-term probably have greater appreciation. Not only do 1031 exchanges let you defer gain, and they give you the time value of that deferral, but there's a whole variety of other benefits of 1031 exchanging. It allows you to buy something with greater cash flow, with less management expenses, diversify, consolidate, relocation or expansion of a business. But what I really wanted to note is that the gain is deferred as long as you own the property. And if you own the property for the replacement property for 5 years and then you want to sell, if you could decide, do I want to sell and settle up and pay the tax to IRS, or do I want to exchange again? And there's no limit to the number of times you can exchange. So exchanges are a great way to build a real estate portfolio with pre-tax dollars. And somewhere down the line, if we do an outright sale, it's when we settle up. But if we hold on to those properties, because all of us think real estate's the best investment out there, when we pass away, our heirs get a stepped up basis. And we all know that means they inherit the property at the current fair market value at the time of death. So that means all of the gain that they deferred during their lifetime and used to grow that real estate portfolio is forgiven at the time of death. And currently, the first $11.5 million of one's estate is exempt from estate taxes. So it's not only a strategy to build wealth, but also pass that wealth to the next generation. So let's do a quick review of the rules. And we could look at this and I could go through a few things, but when you get the slides, you'll see that everything is spelled out. When you do a 1031 exchange, everything starts the day you sell your old property. We call that the relinquished property. And you have, from that date and time, 45 days to identify property that you would like to acquire. And running concurrently, you have 180 days to acquire everything that you want to acquire. We call that replacement property, the replacement property. But the rules say that you have to utilize a qualified intermediary to facilitate that 1031 exchange. And that's the role I play in the transaction. As a qualified intermediary, we are an independent party. We cannot have provided real estate services, legal services, tax services, financial advisory services in the past 2 years. The only thing we could have done for that taxpayer in the last 2 years is act as a qualified intermediary. And the exchange must be set up prior to transferring title. The qualified intermediary will handle all the exchange documentation, coordinate all the details with the closing agents, review the closing statements to look for potential red flags that will trigger a taxable event, keep your clients aware of all the time deadlines, answer all their questions, and really guide them through each step of the transaction. What makes properties qualify for 1031 treatment is its use, not the particular type of property, because any kind of real property can qualify for 1031 treatment as long as it's used for business use or investment. The next requirement is that your clients, the exchanger, cannot touch the sale proceeds. Those funds are held in an account by the qualified intermediary, and they are ready for earnest money deposits and the acquisition of that replacement property. We've already touched on those 45-day and 180-day time periods, but let's be realistic. 45 days go very, very quickly. So the best advice that you could give a client and the way that you could be a great resource for them and partner in this transaction is to start looking for replacement property as soon as they've got their old property under contract with the buyer, if not sooner, because we want to make sure that there's time to do the due diligence and be pretty certain that when we identify that property, we know that we're going to have it under contract and be able to close on that property. So we want to make sure that we utilize the time before the 45 days start clicking so that we can maximize our time and try really hard to get something under contract by the end of the 45 days. In order for your client to defer all of the gain, they must acquire something of equal or greater value, and it must have equal or greater equity. A trade down in value or equity is taxable to your client. And the last requirement I have is that the same owner or the same taxpayer that holds title to the old property has to acquire the replacement property. that's the taxpayer that's been reporting all the income and expenses on their tax return, and that's the taxpayer that would have the tax liability. So unless that same taxpayer acquires the replacement property, they won't be able to report it on their tax return. So with that, I'd like to introduce you to Delaware Statutory Trusts, or DSTs, and talk about how they can grow your business. And Craig, please feel free to jump in at any time.
Sure.
So when you're meeting with someone that owns property, a lot of times they have appreciated property and they don't want to sell because they're looking at that huge tax liability. And they don't know often about 1031 exchanges. And this is the conversation that you have with everyone that you're talking to about listing your property, what to do with the proceeds, the tax consequences of the sale. And they have three choices. They can not sell and do nothing. They can 1031 exchange and defer the gain, or they could sell the property and pay the tax. But if they're interested in 1031 exchanges, they can acquire traditional replacement property, have fee interest, own 100% of it, or they can look at the Delaware Statutory Trust as another option. Because as you learn more about the DSTs, you will learn that it could answer a lot of, or be the solution to many of the problems that your client is putting up as to why they don't want to buy another property. So a Delaware Statutory Trust is a way to acquire a fractional ownership interest in commercial real estate as replacement property in a 1031 exchange. It was designed specifically as a replacement property alternative in a 1031 exchange. The structure is allowed under Revenue Procedure 2004-86. But DSTs are a grantor Delaware trusts that allow individual investors to acquire a piece of it. Each co-owner is treated as owning a fractional interest in the trust. And despite its name, Delaware Statutory Trust, the properties can be located anywhere in the U.S. They're just formed in the state of Delaware. And the ownership is conveyed via a deed. The DST owns 100% of the real property, and the individual investors acquire a beneficial interest, and those individual investors have limited personal liability in the real property and the financing associated with that property. All of the financing is non-recourse. So this is a great example of how a DST looks. And there may be a DST that only owns one property in it, or it could be a DST where you have a portfolio of properties. So the one on the left shows that it's just one multifamily, and the one on the right shows that there are 5 different properties in that portfolio. And I do see a question about, is a DST different from a TIC? And many of you remember when we saw lots of companies promoting syndicated tenant and common interest, and they are still out there promoting them, but it's a different type of a structure. And with a DST, you don't need all of the co-owners to make the decisions for the DST, for the management of the DSTs. You don't need all of them to agree to make any decisions on whether to sell or whether to enter into an agreement of sale or any of those things. With a Delaware Statutory Trust, there is a sponsor, and we'll talk about the sponsor, but there's usually someone that is managing those properties, and it is not a, let's see, you know what, let me go through the slides because I think we'll answer, you'll see how a DST is structured. Okay, and I saw the question pop up, is it like a REIT? And it is somewhat like a REIT, but a REIT doesn't allow you to acquire stock in it as part of a 1031 exchange. So the type of properties that are in a REIT are very similar, or the exact type of property that will also be in a Delaware Statutory Trust, except the Delaware Statutory Trust is set up specifically to allow you to acquire it as a replacement property in a 1031 exchange. So what's nice about the Delaware Statutory Trust is it provides your clients opportunity to access institutional grade investments with as little as $100,000 of equity. So the example where we talked about where that taxpayer sold a property for $500,000 and he had $250,000 of gain, he could have taken all of his $500,000 and rolled that into a DST and diversified that into 2 or 3 or 4 or even 5 different DSTs, splitting that $500,000 up into 5 investments of $100,000. But DSTs are a long-term passive investment. So you should assume when you're entering into an agreement to acquire a DST that you are going to be locked into that investment for 5 to 7 years. It could be more, it could be less, depending on the market, depending on opportunities that might pop up. And what is really nice is when the DST eventually, so they set up a structure for 5 to 7 years. The financing is all based on that. And in 5 to 7 years, when they eventually sell the property in that DST, then it gives all of the individual owners of that DST the opportunity to exchange again into something else. And at that point in time, they could, again, look at all of their different decisions. They could sell and pay the tax. They could 1031 exchange into just traditional real estate, or they could 1031 exchange into another DST. DSTs can include any type of asset class, and they offer the opportunity to diversify, not just the asset type, but the geography of those properties or assets. And as I said, you can split the funds over several different DSTs. Some of the benefits of a DST is the passiveness of it. It's a very passive investment. You don't have hands-on management. Any of your clients that are managing properties themselves or paying for a property manager, they know the headaches that come with managing properties. It gives you access to current and predictable stable cash flow. And we've talked about the opportunity to diversify and acquire institutional quality real estate, but it's access to pre-existing financing. It's non-recourse and there's no investor liability. And while there's a low investment minimum of $100,000, Craig and I have both seen occasions where somebody has less than $100,000 and we're able to help them acquire a DST. It gives you a new depreciation schedule the same way as by acquiring a larger replacement property. And again, you still have the stepped up cost basis after you pass away. Craig, before I move on, do you have anything that you want to add about the benefits or the structure of DSTs?
Yeah, and we'll get to that as we progress also.
Okay.
Finish up this slide and we can.
Okay, sure. So one of the big mysteries, and well, I don't think it's a mystery at all, but one of the big mysteries people seem to think is out there is how to identify a DST on a 45-day identification. And the DST must be identified by listing the name of the DST as well as all of the properties included in the DST. And then you have to take it a step further, and the taxpayer has to note how much, like what's the fractional interest in the DST that they're going to acquire. So they can list just, I'm acquiring a 6.897% interest in XYZ DST, or they can list all the properties out there. And their qualified intermediary can certainly help them with that. Each property included in the DST must be counted as a separate property, even though they are part of the same DST and sold as one package. So we get a lot of questions about that because people are trying to identify 2 or 3 different DSTs, and it's very easy to fall outside the 3 property rule or the 200% rule. when it comes to identifying. So most of those people are looking at the 95% rule, and that 95% rule says you can break the 3-property rule and the 200% rule as long as you acquire 95% of everything you identified. And usually when you're identifying a DST, that's not hard to do. Alrighty. So one of the big differences between a DST and traditional real estate is that a DST is sold as a security by a licensed registered rep. A DST buyer must be an accredited investor. And in order to be an accredited investor, a person must have an annual income exceeding $200,000 or $300,000 if they're married filing jointly for the last 2 years. They can be a person with a net worth of at least $1 million, either individually or jointly with a spouse. And if it's an entity, the entity must have assets exceeding $5 million. If all of the equity owners of that entity are accredited investors, then the entity is also an accredited investor, automatically an accredited investor. And here are the different parties and their roles in the 1031 exchange. So we have you, really the most important party to all of this, the real estate professional that lets the client know about 1031 exchanges and DSTs if that seems like it's a good solution to what their problems are. You're going to help your client sell their old property and get that property to closing. And oftentimes it is you that is referring the qualified intermediary and the DST broker dealer. And no doubt you will remain a resource to that client in the transaction. And then we have the yes.
Let me just take a little minute here to start
Sure.
chiming in on this. I wanted to let people know, I am, as most people know on the call, that I'm with KW Commercial Real Estate. So I am a real estate professional also. But when I started acquiring my properties in the 90s, I started doing a lot of 1031 exchanges for my own portfolio, where I sold properties successfully. And then I did some sales of those properties where I didn't do 1031 exchanges. And that's kind of where the fire started for me to kind of do a niche as the 1031 exchange guru, so to speak. But I found the need where the DST was also a good component to it. So we'll get into some of the reasons why that is. So I am duly licensed. So in fact, I'm doing a 1031 exchange right now on a real estate transaction where I listed this property and sold the property, and now it's a $2 million transaction that's going to be up in New Jersey, and that's not a DST. But then there's a lot of need out there where it makes sense to become a DST investor doing a 1031 exchange. And I had a conference call just the other day with a client who knew I was with KW Commercial, and I was with a broker dealer called RCX Capital Group when my prior meeting with them, and then I just switched over to McDermott Investment Advisors for my security license. So I wanted to just differentiate. It took them a while to understand the difference between a sponsor and a broker dealer. So the DST sponsor is the company, the large company that puts the deal together, puts the DST together. They do their due diligence, they put the financing together, and once they complete that, and they do often serve as a property manager. Once they complete that, then they offer it to the investors for the 1031 exchange. The DST sponsor, however, does not sell to the investor their percentage of ownership. It has to be done through somebody like myself as a registered rep with a broker dealer. So the DST sponsor does the due diligence on the product itself. And then once it's available, it then gets marketed out to the broker dealers. In my case, I'm associated with McDermott Investment Advisors, who then does the due diligence not only on the deal or the DST itself, it also does due diligence on the sponsor, making sure the sponsor's been around a while, they have a track record. And then once the broker dealer does their due diligence on the sponsor and the DST that they're offering, at that point, then we, as their registered reps, are able and allowed to offer it to investors for 1031 exchanges. And so I'm a registered rep, and then Margo then would be involved as the qualified intermediary to finalize the transaction and do the DST.
Oops, sorry, I didn't mean to do that. Hang
No,
on.
that's okay. It's probably very timely. So go ahead.
No, and Craig, if you want to just finish, so did you have anything else to add to the registered rep, their role?
Yeah, the registered, so just to the point of the registered rep role, I just back about 2006 into 2007, I found the need for some of the smaller investors, less than $1 million, that had enough with owning real estate. And when they were sick and tired of the management and knowing about the DSTs, I realized, you know what, I really want to focus on the 1031 exchanges. I think it's time for me to go for getting my securities license, which is not fun. Most of the material doesn't have anything to do with what we're going to do in the 1031 exchange realm, but I went and did it anyway to be able to have dually, to be dually licensed so I can do both. So go ahead, Margaret, hit to the next.
Sure, and I've already talked about the role of the qualified intermediary.
DSTs are valuable to a real estate professional, and what I like to do with other brokers, I do a lot with KW commercial brokers, but I also do it with other companies and brokers outside of my KW commercial world, where I help them with a chance to get a listing. And they have a seller that has been owning their properties for 25, 30 years, 15, whatever it is, and they're tired. They are ready to move on to something else. They're, maybe they're a little bit older and they want to just not manage things anymore. And most people, investors, don't really know what a DST is. Most attorneys don't know what a DST is. Most CPAs don't know what a DST is. Most real estate brokers don't know what a DST is. So what I do is I help them get the listing with explaining what they can do and what their options could be so that they don't have to pay their capital gains tax upon the sale of whatever they're looking to sell. I've got KW commercial, 2 KW commercial guys that are, they specialize in helping clients sell their residential portfolios. We've got one that's got 20 single family homes that he's selling with a very low basis. He's acquired them over time, and now he's going to be selling it for $1.4 million, all the entire portfolio. And now we're going to be going and doing going into several different DSTs. They don't have any interest in doing a single tenant triple net deal or a real estate deal. They only want to go into a DST. So the DST can be valuable if anybody wants to, if they're going to get a listing and they're sellers on the fence about it because they're going to get hit with a big capital gains tax. I'm happy to come in and help. We can do a Zoom call and kind of go over the benefits of that. And you, as brokers, get the listing on it, and hopefully down the road when it's ready to get to sell, we can get back involved and do the, get them invested into the DST. We'll get into some more stories and some examples a little later on too, but DST, I always use a DST as a backup, as a potential rescue in case the real estate deal that you're going into on a 1031 exchange potentially could fail. We all know when you get into due diligence, there's something that may go wrong. And what do you have left? Well, if you don't have a backup, you're going to have to, pay your tax, and it's called a failed exchange. So it's a good backup plan. It can save the 1031 exchange in the 11th hour. Again, we'll have some examples of that. And I could, if somebody closed today, we could have them in one or several DSTs, by next Friday or next Thursday or even next Wednesday. It's very quick. There's really no closing costs because they're built into the DST. The way the DST would work is the sponsor acquires the DST, let's say for $50 million. and they offer it to the investors after they package it, do their due diligence, pay their attorneys, pay their other due diligence professionals, and they sell it to the investors for, let's say, $65 million. And in that spread is where the costs are. And then when we offer it to the investors, their cash on cash return, or the return that they're going to get, is based on the higher, the $65 million number, not what they bought it for. So when you go into it, there's really no closing cost at the settlement table. There is no settlement table. Okay, well.
Okay, Craig, do you want to go through a couple of case studies that show how DSTs worked for your clients?
Sure. So this first one is the another portfolio. A client bought single-family homes out in Arizona. They bought them in at a time when it was, about 10 or 12 years ago. And they bought it for a very low basis, new construction, and now they're selling them for $1.5 million. Their initial purchase was $550, depreciation $450. It's a little bit larger example that Margo went over earlier. So the taxable gain, potentially, if not doing a 1031 exchange, would be $1.35 million. And this is an example of the difference where if you, on the left side, did not do a 1031 exchange, your net equity to reinvest, whether it's in the real estate or the stock market or anything else, is going to be a lot lower than if you did a 1031 exchange and reinvested it into another mechanism. Now, this story could be a DST, or it could be a fee simple real estate transaction, but it just shows the difference and the power of the investment going forward.
Craig, I think it's important to note that this analogy is really valuable to show to your client, because many times they're looking at that tax liability of $341,000 and saying, well, if I give up all that money to taxes, why should I sell the property and have less money to put into the replacement property? I'll just stay put. And letting them know about 1031 exchanges could be the difference between them staying put and putting that property on the market and listing it with someone.
Yeah, and one other thing with that too, the other part of it, and it happened with me with my sales of the properties that I did not do a 1031 exchange on. You look at your let's say $1.158 million that you're going to get as your proceeds after the transaction is completed, and you say, I've got plenty of income and to pay that tax, so I'll just pay the tax and just move on. And then, it could be maybe 9 months or longer before you actually have to pay the tax when you file your tax return. And that's where that federal tax due, when you actually have to write that check out, that's when it really becomes painful. And most people don't realize that until you have to write the check out.
And Craig, it's also important to note that with $341,000 of taxable income here through capital gain, especially all of those capital gains, that's going to put someone into the highest income tax bracket and the highest capital gain tax bracket. So all of their other income is going to be taxed at a much higher level.
Good point. So what happens with the 1031 exchange, it's a wash. So on the right side is the 1.5 million. That 1.5 million just kind of does not get added to your tax return because you're doing the 1031 exchange. It's kind of a wash. So you're right. Good point, Margo. Thanks for bringing that up.
Mm-hmm.
Case study 2 is a client that he's in his 80s, has been going through in Upper Montgomery County a land development deal that he's been working on for about 8 years in the development process. So you guys know that it's not quick. They are coming up very close to doing their closing for the development. It's a $3 million deal. So the seller has 3 daughters. They're all in their 40s and 50s, and they all have their own families. And what he's decided to do is do a little bit of estate planning. And he's going to have his daughters get involved with the decision of what the replacement properties are going to be. and he's going to have 1 million per daughter, as he's going to give them the basis of 1 million per daughter. Then they can then figure out what DST, and in this case, it's going to be a DST, what they're going to go into. So when they do that, he's actually going to go into 3 single member LLCs. If you go back to where Margo said, it has to be the same entity that you're selling your replacement property to go into your replacement your relinquished property, then to go into your replacement property. And the one criteria, Margo, if you want to talk a little bit about it, is the single member LLCs that he can set up. And then even though he's still going to be the beneficiary of the income from the new investment, when he dies, at the stepped up basis, their daughters are going to get the benefit of not having to pay any capital gains tax. And that's his whole game plan. He wants to provide for his daughters and their families.
Right, and just to follow up on that, I mentioned earlier that the same taxpayer has to acquire the replacement property. And it is possible to set up a disregarded entity, such as a single member limited liability company. So if that father would take title to 3 different DSTs, or each one could be set up in a separate single member LLCs, and it would be really easy for those daughters to each take one upon his death, and either continue holding the asset with a stepped up basis, or eventually, sell that and not have much tax to pay because they did get that stepped up basis. And Craig, here's number 3.
Yeah, so this one, and fortunately, I was not the real estate broker on this, but I get called in a lot of times when there's an issue. So this one was approximately $10 million apartment deal in Manhattan that sold as their relinquished property. They wanted to go down to Delaware and look for a retail shopping center deal. And what they ended up doing is really loving this shopping center. And they did this in their, before their identification time period came, but they did their letter of intent. Letter of intent got accepted by both parties. The owners of was one LLC with 3 owners in that LLC. When they did their letter of intent, everybody agreed to it. And then they started working on the purchase and sale agreement. 45-day period was, their identification was this one property because that's where they were going, and they didn't identify anything else. I don't remember exactly how long after the 45-day window expired and their identification was completed, but one of the 3 owners died. And as the attorneys were working on the purchase and sale agreement, but not signed by the sellers and the buyers, the CPA for the widow recommended that she does not sell. And it was no agreements were signed at that point. So she ended up saying, we're not going to proceed with this deal. And because they only identified the one property, in this case, a $10 million deal, they had a failed exchange. They had to pay their taxes on the $10 million that they were going to go into this replacement property. So if they'd identified, I recommend all my clients to identify, at least doing the 3 property rule, where even though you're 95% sure you're going forward with one deal, maybe identify another real estate deal and then a DST at the end to make sure that you're going to be protected and save the exchange. Because again, we can get into a DST very quickly.
And number 4?
Number 4 is, so we had a retiree. He owned 6 rental properties, and he's got 1 more left. Most of them small, single family, duplex properties up in Pennsylvania. He relocated to Florida, but he still owned these properties up here. And, he still had to deal with the tenant turnover. He still had to deal with the plumber that had to come. He was just getting tired, and he was not close enough anymore. He just was wanting to move on. I was referred to him by another real estate agent, and explained to him that he could do something that's completely hands off. He doesn't have to worry about anything. It's completely managed. So we ended up going into, he sold his properties one by one, and we ended up doing each property and into a DST. So go back, if you can go back to that first slide there, there's,
Oops.
Nope.
Sorry.
So they're the first two properties he sold. They were actually up in Sellersville, Bucks County. They each sold for $205,000, and he had mortgages on them. So the equity that he had to go into was approximately 50% of the equity. So he had about 100,000 that he had to go into it. Now, a key point with the mortgage there is you not only have to replace, as Margo said, the value into a new DST equal or greater in value, you also have to replace equal or greater in value of the debt. And the DSTs are a lot of them are comprised of having debt. They're typically somewhere in the high 40% to 55% loan to value to accommodate that situation. So all the client has to do is invest their 100,000 equity into the DST, and they're good to go, and they're satisfying the exchange. So they're just some of the examples of the properties that he sold. We did each one individually over about a 1.5-year time period. I did not sell the properties. A residential agent sold the properties. They got paid their commission. And then when they were ready to go, I stepped in to help them do their replacement properties into the DSTs. And that's just their total. On the sales side, I was just for the residential agents. Most time, that's going to be a residential agent that does that, and that's their gross GCI if sold it.
Oops. Okay. And then number 5.
This is one of my fun case studies. So it was 2016, I think it was, and I kind of had a rough week. It was around 3 o'clock, almost 4 o'clock on a Friday afternoon, and I had it for the week. About ready to go down and have a scotch and just click on some golf. I remember it was March 18th of 2016, and so I got a phone call from a residential agent out of Newark, Delaware. I frankly had not met. She knew that I do the 1031 exchanges, and she said, "Craig, I just got referred a client that today is their identification day. They've got to identify their property, their ID by the end of the day here." I'm like, "Well, great. Thanks for giving me enough time." So the only way to go here was to go into a DST. And so what I ended up doing is helping them identify. They had a real estate deal that they were working on. The poor guy he's 85 years old, was going through LoopNet for the last 45 days. And he had a whole binder full of them, but he was doing it on his own and calling the brokers, and it wasn't getting anywhere. He did find the one property for $1.2 million that he was going to reinvest. I think it was $1.4 million. So they were going to come out of pocket with a little bit. And then, so I helped them identify that, and I helped them identify a DST, which was comprised at the time of 2 BJ wholesalers. One was in Baltimore, one was in Boston. So that satisfied their identification. And I said, I can sleep at night because I was able to help these folks complete their identification in the proper time. And if they go on with a real estate deal, which was their primary choice, then at least I satisfied my requirement. So in May 5th, I called them up for a little bit after that probably, and they said, yeah, we went under contract for the real estate deal, which was a strip center in Dover, Delaware, I believe it was. And they were really hoping to go forward with it. They hired their attorney, they did their purchase and sale agreement, negotiated the deal, got their inspectors out there, did their building inspections, and there were some issues. And they were trying to negotiate the issues, and it got to a point, and they had 30-day due diligence, that they weren't really trusting what was going on with this building and the scenarios that were in place. And I had nothing to do with it. I wasn't a part of the sale of the real estate deal. It was another real estate agent. And actually that agent had both sides of the deal. They ended up getting it out of it in due diligence on June 5th, called me shortly after that and asked me if the BJ's was still available. And I I made sure that they had enough equity in the DST before I identified it. So hopefully there would be a cushion there, and it was available. So when we went down and we ended up doing the DST, and what was interesting is their son had no idea about a DST. Talked to their attorney who did the real estate deal agreement about DSTs. She had no idea. She'd never heard of them, and she's putting in a little bit of doubt of that it even exists. So they asked for referrals from other attorneys, and the only attorneys that I really had that understood it were attorneys that were in the real estate or the qualified intermediary role. And so what ended up happening, which was an interesting thing, is he Googled the one property in Delaware. I'm sorry, it was in Baltimore. And the reason he did that is just to see if it was there. And unfortunately, what ended up happening was he Googled it, and because it was a brand new redevelopment deal, it was a dilapidated warehouse, which was the most recent photo. So that made him even more suspicious. So I said to in this case, their names were the Wangs. I said to the Wangs, I said, look, today it's, I put it on Waze. I was sitting at their house. I said, this BJ's is an hour and 5 minutes from here. Tell you what, I'll pick you up tomorrow. We'll do a little field trip, and we'll go take a look at it. And it was a beautiful day. We had a great ride, and they just were thrilled with it. And there was not even a crack of the parking lot. That actually is the BJ's. They have a nice brand new gas station in the back. Bottom line is, it was a successful transaction. They ended up doing a couple more smaller deals with me because they loved getting the returns, which is a direct deposit. They get a statement every month, and then at the end, their statement goes to their accountant, and it takes care of it. They're literally hands off. They don't make any decisions, and it's just a good investment for them. So that's the benefit of doing a backup and having a successful exchange.
And Craig, I can definitely attest to the fact that I talked to many clients on day 40, 41, 42, 43, where they are freaking out because they haven't found any desirable replacement property, and that time clock is clicking. And we have recommended, we've given them a list of a couple of different DST registered reps, and they have been able to identify property, and it all worked out great. All right, Craig, do you want to talk about this?
We can get into some questions, unless Margo has a couple others. But the DST market, and mostly DSTs at this point, not really the tenant in common anymore. These are the sponsors that are in the game and in the DST world. It just shows the breakdown of the different product types. The one thing I wanted to go over in this slide is when a client has, let's say they have 500,000 left over in boot. Maybe they have more left over in boot, meaning that they went into a real estate deal of a $10 million deal, let's say, and they got a good enough deal that they're into it for $9,500,000. Then the rest of it can go into a DST if they don't want to pay any taxes. And I like to diversify. I like to go into maybe an apartment deal, maybe a self-storage deal, so that they can diversify not only by product type, but also geography. So this chart just gives you a breakdown of the different sponsors and the different types of product and which ones are the most popular. And also the chart down below shows the equity raised and the timeframes that they were raised in.
Well, Craig, I know we have a lot of questions, so let me just move to the end here, and then we can certainly open it up for those questions. But the bottom line is that 1031 exchanges are a great way to help your clients build their real estate portfolio with pre-tax dollars. And DSTs are a good solution for those that don't want to sell their property because they don't want to manage another property. And the more you know about 1031 exchanges, the more you can benefit from them, and the more you can help your clients and use it to grow your business. So here's our contact information. But Jen, do you want to read those questions, or let me look and see if I can pull them up?
I have some here. So let's talk about the one question is, does DSTs have an exit or resale option? Technically, no. And if somebody is looking to, they're not as liquid as a real estate deal may be. But if your client's going to go into a DST, they really should want to go into the DST and not necessarily need the money, which is why they need to be an accredited investor. That being said, there are ways if you need to get out of a DST, or your clients need to get out of a DST. There is a small market. There's really no secondary market officially, but there's a small market out there that the first way that they can sell them is the other investors in that DST would be they would be offered to them, and they would have the ability to buy them out of their position in their DST. However, typically when that happens, they're going to not only have to pay the commission, but also they're going to be selling it at a discount, kind of like a discounted loan. Hopefully that answers your question. And if there's any other questions after this that you have, or a situation, please feel free to call me. Obviously call Margo, whatever the question is, but I'm happy to help with potentially your deals.
Then there's a question here. Can I reinvest 50% of the sale proceeds into replacement property and choose to pay tax on the other 50%? And my response is yes, you can, but it's essential to have their tax advisor look at the numbers to make sure if you only reinvest 50% that you will actually have any tax benefits to the transaction. Because if 50% is not at least the value, if the basis of the replacement property isn't 50% of the sale price, there's not going to be any tax benefits to you. So I would hate to see you go through the effort to do the 1031 and not end up with any tax benefits.
Another question I see here is, how does the DST improve one's access to institutional real estate? The DST is, for the most part, pretty much institutional grade quality types of properties. They're mostly anywhere from 30 million is probably the low range for the equity. And actually, if you have debt on it, the deal itself is going to be probably 60 million. So they are pretty much higher quality assets, Class A. I've got an apartment deal up here now in front of me. It's a $62 million apartment deal by the sponsor is Next Point. I've got a self-storage DST, which is just coming out. Flatirons is the sponsor there. That transaction for the total offering is $30 million. And it's comprised of about 8 different properties in one DST throughout the middle part of the country. And then there's a medical office DST that has multiple properties in it, some student housing. So the answer is yes, this is pretty much getting you as close as you can with $100,000 or more into an institutional quality type property.
And there was another question about when did DSTs come into existence, and it was a revenue procedure that was issued in 2004. It was revenue procedure 2004-86 that started this whole thing.
Yeah, anybody has any questions on compensation, that kind of thing, or it's a different license. It's a securities license. When you call, just call me. We could discuss, how that, how the compensation is. We can't, as a securities advisor, pay out a commission without you having a securities license. But give me a call to discuss further on that.
And I see Monica had a question about a particular client, and feel free to give me a call. The simple answer is no, it's not that easy. She has an S corporation with 2 partners. One wants to move forward with the 1031 exchange and one doesn't. And it takes a little bit of planning. It's not just a simple answer.
How quickly, I think Margo answered, how quickly can you trade out of a DST? It's specific to the DST. It depends on what type of DST is and the structure of it. In some cases, the exit, projected exit is going to be based on the loans that are in place. And in other cases, it's just going to be the hold time period. And they range from 5 to 10, 5 to 7 years is the typical hold time of a DST. When we're doing a DST, it's a very thick PPM that has to go with it, and everything is spelled out in the DST PPM on what their projections are. They also have a lot of reserves, and it goes over specifics there when we're doing our due diligence.
And I know we have to wrap up, but there's one question from Rob. He said, won't DSTs have significant multiple fee levels impairing the returns to the investor versus the 1031 exchange? And will an investor in a DST enjoy a share of the depreciation? So we're going to answer 2 of those 3 and then have Craig answer the first part of that. But whether you whether you acquire a DST or you acquire traditional real estate, you've done your 1031 exchange. So when you acquire a DST, it's the same as any other 1031 exchange. It's just rather than buying traditional real estate, you've bought a DST interest, and you will still enjoy depreciation just as you would any other real estate because you're an owner of that real estate. You're going to be deeded a piece of that. Craig, do you want to talk about the first part of that, which was won't DSTs have significant multiple fee levels impairing the returns to the investor?
Yeah, that's all spelled out in the PPM. But as I mentioned earlier, the fees, a lot of the fees are loaded into it already. So that's your going in fees. There are really no closing costs because they're built in. Once you get in and it's spelled out in the PPM, sometimes they're master leases, and the master lease manager may end up getting more rent, but it's going to pay you a little less so they can put that into the reserves. When we talk about cash on cash return, and that cash on cash return that's spelled out is what they project that you're going to be getting, is in fact the true cash on cash return for what your cash that you're putting into the deal is. So there are fees before the distribution gets met, but the PPM is going to spell out what your return is going to be going forward. Hopefully there's projections in there, and hopefully that gets increased, and it's all going to depend on each specific DST. There are some value add DSTs where there should be growth, but at the end of the day, and hopefully there's appreciation, you're going to get the benefit of not only the cash flows over time, we're doing nothing with it other than giving it over to your accountant, but you're also going to get the benefit of the appreciation, hopefully, at the end of the cycle and do the 1031 all over again. Hopefully I answered that question.
Jen, do we have time to answer any more questions, or I know there's a few more.
Yeah, I think we're already over our scheduled allotted time. So I think at this point, Craig and Margo have both put their contact information on screen. Everybody will get the presentation with their contact information following the conclusion of the webinar. So I think it's time to wrap up, and Stacy just has a few words to thank everyone.
Just for everybody, when you leave the webinar today, everyone will get a survey when you exit. It's only 3 questions, so we'd really appreciate it if you could take a minute to respond so we can continue to provide good content at these webinars. Wanted to thank Margo and Craig again so much for sharing your expertise with us today. Obviously it was well received. We look forward to staying in touch with you, and just also want to remind everybody to visit our website for upcoming webinars, and also you'll find real estate related COVID resources on the Institute's website as well. So thank you again, everybody. Have a great day.
Thank you.